Hey, it's Mark Ferguson with Invest for More, and today the Fed lowered interest rates a 0.5 point. So this is much more than was expected. It's the first rate cut in 4 years, and we're going to talk about what this might mean for the housing market, inflation, and some other items. Now, I have been an advocate for cutting rates for a long time. I was actually an advocate not to raise rates at all. I know I was an outlier, but my belief is high interest rates do not help inflation. They might actually cause it, and they definitely don't help lower housing costs. There's many studies that reflect that, and they definitely do raise mortgage payments and the actual payment of houses, which hurts a lot of people. Now, I know a lot of people say, but I want lower prices, I want prices to go down, and they've been told that higher rates will do that. But they don't, unfortunately. In fact, I think high rates might make it worse. I personally own a store. I see how high rates impact us. I run multiple businesses. I see how high rates impact them, and it's all negative in the fact that it raises costs, does not lower them. So we're going to talk about a lot of this and what might happen in the future. And there's some people who think that lowering interest rates will lower real estate prices as well, and we'll touch on that too, and what I think about that. So what did the Fed lowering rates do to mortgage rates? Because they are not the same thing. Mortgage rates are what you would pay for a house loan. The Fed funds rate is the rate the Fed Reserve decides to lend money to banks, and there's all kinds of different things that go on there, but the Fed could raise rates, and mortgage rates will usually go up too, but not always, and not always in the same manner. The Fed could lower rates, and mortgage rates usually come down too, but not in the same manner. It's almost kind of an anticipation of what the Fed will do. And as you can see here, if we scroll down here, I'm using nerdwallet.com because it's more of a real time. Freddie Mac is good too, but they're over a week old on their interest rate charts. But as you can see, look at this. Rates, 5.7 for a 30-year mortgage. In June, we're at 7, over 7. I believe earlier, if we expand this chart, it was closer to 8 earlier in the year. So rates are way, way down. That means people can afford houses much easier. Cost for borrowing is lower for everybody, which makes it easier to expand, produce more goods, and lower costs. So we'll see what happens here. They have a real weird thing here where their ARM is more than the 30 and 15. Don't know why, but like I said, this gives us more of a real-time sense of what is happening. And this number seems to be pretty accurate, their 30-year mortgage. So rates are going down. What does that mean for the housing market, though? Well, a lot of people think if rates go down a bunch, we'll have a huge surge. A lot of buyers will hop in, prices could go up. And that could happen. In fact, that might happen. It might be likely for the next year, as a lot of people are sitting on the sidelines waiting to buy. There's a lot of renters waiting to buy. There's a lot of homeowners waiting to buy because their rates are so low on their current house, they don't want to swap that for a really high rate and buy a worse house than what they have now. So you could have a surge. But lower rates also make it easier to build. If rates decrease, there should be more building. And in the long run, that's better for us because more building means more supply, a more stable, evened out housing market. And there's a big decrease in housing units available right now. So a lot of people, again, want to keep rates high because they don't want prices to go up. But you're just kicking that can down the road because you're just building up supply higher and higher and higher. And eventually, you're going to have to lower them. And the longer you wait, the worse that surge is going to be. The sooner you lower them, the smoother that curve will be. And oh God, I hate to say flatten the curve, but for this situation, I think it's better to have lower rates sooner than just keep them high and prop things, kind of try and hold back this demand artificially. Now, there are a few people who think lower rates will lower prices, and it's an interesting theory. Their theory is that it will bring more supply because we just said there's a lot of sellers waiting on the sidelines, and they say, well, if you lower rates, these sellers are going to be willing to sell again, and they'll put a bunch of houses onto the market. And that could be true. There could be more houses coming on the market, but all of those sellers waiting to sell because they can't afford to buy or they want to wait till rates are lower to buy are buyers, right? So you've got this amount of people wanting to sell and waiting to sell because rates are low. All of a sudden, all these houses come on the market. Okay, that same amount of buyers are right here willing to come on the market and buy. So you didn't increase or knock the inventory out of balance, the supply and demand curve out of balance. You just bumped both sides up. But also, there's a lot of renters out there waiting to buy too. So here are the sellers. Well, there's also all these renters on this side who are going to jump on top of those sellers and increase buyer demand over here. So if anything, we should see an out of balance curve towards the buyers, not towards the sellers when rates drop. Okay, some other interesting data. A lot of the rate drop has to do with the economy might not be doing as well as it was before. Unemployment's increasing. Job growth is lower than expected. They've been revising job growth down significantly over the last year. And what's really interesting, a lot of this job growth was boosted by immigration. So you've heard me talk about the Venezuelan gang situation in Aurora. I try not to get political on here. Believe me, I have people accusing me of being a conservative and a liberal both on the same day, depending on what data I'm pulling and what data I'm talking about. I love to look at the data and reports from the source. I don't go to the different news medias and outlets to see what they're saying. I don't go to political candidates to see what they're saying. I pull my own data because I have opinions that are in line with both sides, honestly, about the economy and what's happening. You can call me an independent because that's what I am. So what's interesting is that we've had a lot of job growth lately. This is the estimate of immigration into the United States in 2022 and 2023 from the CBO. The CBO is a Congressional Budget Office. Then you have the Census and Social Security Administration. They all have wildly different estimates, which doesn't give you much faith in our government, but not sure how many of us had a lot of faith anyway. But then we come down here and we look at border surge, and we can see a massive amount of people, of encounters at the border and increases here the last couple of years as well. And I promise this has something to do with what I'm talking about. Well, you can see here, this green is released or paroled encounters at the border, transferred to another agency, not admitted to the U.S. So we had a huge increase of people being encountered at the border, and we had a huge increase of people just released or paroled into the U.S. That's what that means. We had some in 2019, very few before that, and now we've just had massive amounts. So it has been a massive increase of immigration into the United States. And what's really interesting about that is we're talking about employment, all kinds of different things here. This is from the government census data. Here is the employment changes from August 23 to August 24. Foreign born 16 years or older, 46,818 last year. This year, 48,853, an increase of over 2 million employment jobs for foreign-born population. Civilian, non-institutional, native-born, 220,395 last year, 220,003 this year. There's been a decrease of 392,000 jobs for native-born people the last year, an increase of 2,035,000 jobs for foreign born. So a lot of the job growth, all of the job growth has been foreign born. So I'm not saying that's good or bad. I'm just saying that's what happened. And that's something I think they're looking at as well with employment and inflation and different things, is why has job growth gone up? What's causing the increase in jobs, and what kind of jobs are those? So with these increased jobs and increased immigrants, the population keeps increasing in the U.S. So a lot of times that's brought up as well. Hey, population is decreasing in the U.S. Baby boomers are dying off. The housing market's got to crash. There are going to be too many houses because of that. Well, with all this immigration coming in, there's definitely an increase in population, not decrease. Even if the native birth rate is decreasing, the immigration is pushing the population up, which means they need more houses, more housing, more rentals, etc. And a lot of people think that investors are buying all the houses. That's another video I've done too. If we look at our chart here from 2016, the red line is owner-occupied units, the blue line is renter-occupied units. And so people are also saying the owner-occupant rate has actually decreased slightly the last year, just like by 0.1 or 0.2%. But it's not because there's less owner-occupants. It's because there's so many more renters. So in 2016, we went from 75 million owner-occupants. Now we've got 86 million, an increase of 11 million. We had 43 million, 44 million renters in 2016. Now we've got 45 million. 9 million more owner occupants the last 8 years than renter occupants. So not everybody's a renter. It's not really true that nobody can buy a house. It's just that that's kind of a media narrative they're pushing. In reality, a lot of people are buying houses and a lot of people are renting houses too. We need more housing. Immigration is big in that. If it changes, if it decreases, increases, that'll greatly affect housing. You couple this increase in population, this increase in demand for housing with lower interest rates, and that definitely could mean we see more of a housing boom than bust and housing prices increase. Stuff I just want to touch on the inflation versus interest rate argument. I've been making videos on this since 2021 when I said that high rates would not lower prices, and a lot of people just think that if interest rates go up, demand will drop and prices will drop. The simple fact is, if interest rates go up, demand does drop, but supply drops as well. Now, we don't need to listen to me say all this, or we can just watch me talk for a little bit. But the thing is, supply and demand is two sides. It's not just demand, it's not just supply, it's both. So if you lower demand, but you also lower supply, that's not going to cause an imbalance that lowers prices. And in fact, when you raise interest rates, it might cause supply to drop even more than demand because building slows down, which hurts us long term for housing stability, and it causes people not to sell who would normally be selling, looking for a place to buy, and it causes renters not to buy because they keep waiting for lower rates, and it just causes just this stagnant mess of a housing market that does not lower prices and lowers supply because people stop building. So really, it just doesn't help anyone and makes it more difficult for people to buy, people to sell, but doesn't lower prices. And there's multiple studies that talk about this as well that show historically housing prices do not decrease with rising rates. In the 70s and 80s, we had the highest rates ever, and housing prices tripled in the 70s, doubled in the 80s. They just kept going up and up. And the studies say, hey, high rates do not stop housing prices from going up. It does not lower them. Now, this is another video I did about how raising interest rates can actually cause inflation. And people thought I was crazy for doing this, but I'll just talk on this real quickly. The basic premise of high rates lowering inflation is that if you raise interest rates enough, it will hurt the economy so bad, people will lose their jobs, they won't have money, they won't be able to buy stuff. That in turn will lower demand, and that will lower prices. But again, we already talked about supply and demand and about how there's two sides. Well, if there's less demand, a lot of businesses aren't going to just lower prices. They're going to stop producing as much. They'll maybe lay off people, they'll stop producing goods, they'll sell less of it, but they'll keep the prices the same, or they will even raise prices. Why is that? I own a small liquor store and mini mart, right? If my demand goes down, i.e. customers coming in, buy less stuff, if I lower prices, I will go bankrupt. I can't just lower prices and keep selling stuff lower because I have costs, and costs I have to pay, utilities, cost of goods, staff, all of that. So I have to sell a certain amount to make money. Well, if I don't sell enough of it, I can't just lower prices. I have to raise prices. I have to sell fewer things at a higher price to still stay in business. And that's how higher rates cause prices to go up. And it's not just that, but higher rates increase costs too, because if interest rates are higher, cost of borrowing is higher. Almost every company that produces something borrows money in some way, shape, or form. All of my suppliers borrow money. The suppliers to those suppliers borrow money, and if their costs go up, their costs go up, my costs go up, prices just keep going up. The only way high rates really can drop prices is if they cause a massive recession or depression and nobody can buy anything, and companies are forced to just fire sell everything. But at that point, they're not producing anything. They're just fire selling what they have. And then they might go out of business. And then there's less competition. And then the companies that do survive can bump their prices up even higher. So I just, in no way, sense, or form, agree with the idea that high rates lower prices. So for those of you who say I'm wrong or don't want rates to drop because they think it will cause inflation again, I actually think it's the opposite. I think lower rates make it easier to expand. They make it easier to increase supply chains. They make it easier to scale, which means lower prices. Walmart is able to have extremely low prices because they're massive and they buy so much stuff and they can scale. If you lower their demand, that means they can't scale and they have to charge more. Just like with my store, if I sell more stuff, I can sell it at a lower price because I can buy in bulk, I get cheaper prices, and if I'm selling more stuff and have more profit coming in, then that actually means I'm making more money than selling less stuff at a higher cost. So, every sense of business, lower interest rates actually makes things cheaper, there's more supply, and there's lower prices. All right, finally, I'm going to talk a little bit more about inflation. And a lot of people think that lowering inflation means prices will drop. It just means prices will stop going up as much. If there's positive inflation, prices are going up. And normally inflation goes up 2 to 3%. In fact, the historic average is more like 3.5%. But the Fed has said they want it at 2% or they won't lower rates. Well, we've had inflation close to that now. But what's interesting is I want to show a couple of charts here on different inflation rates. First, this is the United States month-over-month inflation. We peaked in June 22. Our inflation was at 1.2% for the month in June. That's a massive inflation amount. They started raising rates kind of in February, but really in April, and kept raising them all the way through July 2023. Inflation had already dropped. It almost gone back to normal in July. So all of these people who say that higher rates lowered inflation, it was already lower. It had already been gone down significantly. And you can see now, inflation's a little bit lower and the rate's been real steady. But I'm a big proponent of, if they hadn't done anything here, inflation, I think, would have dropped lower sooner, especially because housing costs are a huge part of this inflation, and not housing prices, but costs, which means mortgage payments, and those were highly inflated because of interest rates. So I'm just not a fan of the idea that high rates lower prices. And other countries are showing some interesting stuff too. This is Argentina. Argentina's had awful inflation forever, and this is 126% interest rate in Argentina. Yes, 126%. Inflation, an 87% inflation. That's crazy. Well, inflation in Argentina, they just kept raising their interest rate. Inflation went higher, raised interest rate. Inflation went higher, raised interest rate. Inflation went higher, raised interest rates. Well, they got a new president. He's changing a lot of things. And look what they did. The blue line's their interest rate. They dumped their interest rate and lowered it significantly. Look what happened to their inflation. It started going down. And if you look at month over month inflation, it's dropped significantly. It didn't drop when they're raising rates. It dropped when they're lowering rates. We go to Turkey. So Turkey's interesting too, because this blue line is interest rates, this gray line inflation. Now they're right next to Russia. The war really impacted them, and their inflation jumped significantly. But look, they didn't raise rates right away. Sorry, it's jumping all over. They actually lowered rates right here. When inflation kept going up, they lowered rates, and they kept them low. And look what happened. Their inflation dropped. It kind of dropped on its own without inflation, right? Without interest rates going up. Then they had all kinds of pressure from the government. I think they might have changed finance people, and they said, this is madness. We must raise interest rates. We can't lower them. So they raised interest rates to fight inflation. What happened? their inflation went right back up again, rose significantly. Then they steadied them out, and finally it's down a little bit, kind of after they steadied out their interest rates. So all the data, everything I see, the studies I see, all show that raising interest rates raises inflation. And in my own experience with my stores and shops and businesses, that's what happens too, because costs go up, and if demand goes down, my prices have to go up to make money. That's just how business works. So we'll see what happens in the future, but it's good to finally see the interest rate go down. I think that will help everybody. For those thinking that this is going to cause prices to go up, I think it's the opposite. I think you should be happy and embracing this rate cut. It will make business more open and smooth and be able to expand and produce more goods and services, which is what people need. All right, let me know what you think. I know there's a lot of different things going on right there, but I want to make a quick video about what I think of this situation. Of course, we'll have more videos on my businesses, the laundromats, the liquor store, etc., my flips, rentals, all of that coming up here soon.